All right, let's talk about one of the most famous signals in all of trading, the golden cross. We're going to skip all the hype and get right to it, deconstructing this thing with 30 years of hard data to find out what actually works. So, why does everyone talk about this thing? Well, look at this number, a 58% win rate. And that's not over a weekend, that's over 30 years. Now, a number like that, yeah, that definitely gets your attention. We have to dig into that. Okay, so here's our game plan. First, we'll look at that 30-year performance edge. Then, we'll break down the core signal itself. After that, we'll get into the pro-level filters that make it work, lay out the complete playbook from entry to exit, and finally, we'll look at the scoreboard and see what the real-world results look like. So, first things first, let's talk about that performance edge. You gotta wonder, right? How does a pretty straightforward trend-following strategy, like this one, manage to stick around and stay relevant for 3 whole decades? Let's dive in and see why. Well, a huge part of its staying power is just how flexible it is. I mean, it's often called one of the most universal strategies out there. And that's because it's not just for stocks or just for forex. Nope, you can apply this to crypto, commodities, you name it. The core idea, spotting a big trend, is the same no matter what you're trading. Okay, so what is the signal exactly? How does it actually work? Well, it all boils down to 2 key lines on your chart, a fast one and a slow one. These lines are what we call simple moving averages, or SMAs. First up, you've got the 50-period SMA. Think of this as the fast line. It's quick to react because it's looking at more recent price action. It's all about that short-term momentum. Then you've got the 200-period SMA. This is our slow line. It's the big heavy anchor that shows us the long-term, established trend. A lot of people see this one as what the big institutions are thinking. So the golden cross, that's the magic moment, right? It's that exact point where the fast line, the 50 SMA, crosses up and over the slow 200 SMA. What that's telling you, visually, is that short-term momentum is suddenly getting stronger than the long-term trend. It's a huge flag that a new uptrend might be kicking off. But here's a really important catch. Just seeing that cross happen, that's not enough. And that leads us straight into our next section, adding in the pro-level filters. This is where we learn how to dodge those fakeouts, those false signals you get in really choppy markets. Look, a raw crossover signal on its own can get you into a lot of trouble. It's like seeing a mirage in the desert. That's why filters are so crucial. They're our reality check. They help us confirm 2 big things. 1, that big institutional money is actually behind this move, and 2, that we're looking at a real trend, not just a bit of random market noise. So for this strategy, we've got a really simple 2-step confirmation checklist. Step 1, check the volume. You want to see volume picking up right when that cross happens. That tells you there's real conviction, real power behind the move. Step 2, we look at an indicator called the ADX, which stands for the Average Directional Index. This little tool is designed to do one thing, tell us how strong the trend actually is. And with the ADX, there's a non-negotiable hard and fast rule. The reading has to be above 25, period. If it's below that, it's telling you the market has no real direction. It's just drifting sideways. Honestly, this one filter is probably your single best defense against getting chopped to pieces by those whipsaw signals in a ranging market. Okay, so we've got our core signal, we've got our confirmation filters. Now it's time to put it all together. Let's build the complete trade playbook with the exact rules for getting in, getting out, and managing your risk. The entry rule couldn't be clearer, and you can't fudge it. You only go long after the golden cross happens, and only if 2 other things are true. Volume is rising, and the ADX is above 25. You need all 3 boxes checked. No ifs, ands, or buts. All right, you're in the trade. Now, when do you get out? Well, the exit signal is basically the perfect opposite of the entry. It's called the death cross. This is when that fast 50 SMA crosses back down below the slow 200 SMA. That's your big flashing sign that the party's probably over and the uptrend is done. Of course, every single trade needs a safety net, right? A get-me-out-of-here point. For this system, the stop loss is placed at 2 times the average true range, or ATR, below where you got in. Using the ATR is so smart because it's dynamic. It automatically accounts for how volatile a stock normally is. It gives the trade just enough room to wiggle around without getting kicked out by some random market hiccup. And last but not least, let's talk about managing the money. The rule is simple. Each position is sized so you're only risking 1% of your entire account. And what are we shooting for? The strategy uses a fixed profit target of 3 to 1. It's simple math. For every dollar you risk, you're aiming to make $3 back. All right, there it is. We've built the whole system piece by piece. Now it's time for the moment of truth. Let's check the scoreboard and see what this playbook actually delivered over 30 years. This is the reality check. Remember that number we started with? Here it is again. 58% of trades were winners. Now that sounds great, but let's flip it around. That means 42% were losers. It's a solid edge for sure, but you have to go into this knowing you are absolutely 100% going to have losing trades. It's just part of the game.
Let's get a little more granular with these numbers. So, compound annual growth came in at a respectable 12.3%. The Sharpe ratio, that's a fancy way of measuring your return for the amount of risk you took, was 0.92, which is pretty darn good. Profit factor of 1.45, that means for every dollar you put on the line, you made back $1.45 on average. But, and this is a big but, look at that max drawdown, 18%. That means at some point the account was down 18% from its highest point. You've got to ask yourself, could you stomach that? Could you stick with the plan through a drop like that?
Now this is a really interesting one. It's the difference between your plan and reality. Remember how we set a target of 3 to 1? Well, the average actual win was closer to 2.1 to 1. So what gives? It's that death cross exit rule. A lot of the time, it will signal you to get out and lock in your profits before you hit that full 3 to 1 target, especially when a trend starts to run out of steam. It's a trade-off, really. You give up some upside to protect what you've already made.
Okay, if there is one thing, just one thing, you remember from all this, make it this. The market condition is everything. This is a trend-following strategy, plain and simple. That means it absolutely loves big, strong, obvious trends. It shines in a bull market. But its kryptonite? Oh, that's easy. It's a choppy, sideways, go-nowhere market. In those conditions, the lines just whip back and forth, triggering a ton of false signals that can just bleed you dry with small losses.
And that really brings us to the bottom line, the big question you have to ask yourself. Is a system with a 58% win rate worth it when you know you might have to endure an 18% drawdown? And you also know it's only really built for trending markets. There's no right or wrong answer here. It really just comes down to you, your personality, your trading style, and how much risk you're truly comfortable with.